What if you could earn a 6% dividend yield without buying property, chasing tenants, or worrying about interest rates? That's what many Singaporeans are doing through Mapletree Logistics Trust, or MLT, a REIT that owns over 175 logistics properties across Asia, giving you steady passive income from a portfolio worth 13 billion Singapore dollars. In this video, I'll break down MLT's first half of 2025 financial results, explain whether that 6% dividend yield is sustainable, and show how the Fed's rate cuts into 2026 could impact your REIT returns. Stay till the very end, because I'll also share the key risks, what smart income investors are watching, and whether MLT still deserves a place in your dividend portfolio. And if you find this video useful, hit like so more Singaporeans can learn together, and subscribe to Wealth for You for more simple, smart investing every week. Disclaimer: before we dive in, this video is for education and general information only. It does not constitute financial advice, and it is not a recommendation to buy or sell any investment product. All financial information shared in this video is extracted directly from Mapletree Logistics Trust's official disclosures on the SGX website and related investor materials. Always do your own due diligence and consult a licensed financial advisor before making any investment decision, because your money, goals, and risk tolerance are unique to you. Chapter 1. What's a REIT and why it matters to Singapore income investors? A REIT, or Real Estate Investment Trust, lets you invest in large-scale income-generating properties without owning them directly. You earn dividends from rental income, while professionals handle the property management. For Singaporeans building passive income, REITs are attractive because they must distribute at least 90% of their taxable income to investors. They pay regular quarterly dividends, giving you that steady COPI money flow. They diversify your exposure across multiple countries and tenants. No property tax, no tenant headaches, no ABSD. For many, REITs like MLT are the foundation of a cash flow-rich portfolio, income that works for you even when you're asleep. Chapter 2. Meet Mapletree Logistics Trust. Let's take a closer look at Mapletree Logistics Trust, or MLT, one of Asia's most established logistics REITs, proudly managed by the reputable Mapletree Group. As of 30th September 2025, MLT owns a vast network of 175 properties spread across 9 key Asian markets, including Singapore, Hong Kong, China, Japan, South Korea, Australia, Malaysia, Vietnam, and India. These properties aren't just warehouses, they're the vital arteries of modern commerce, powering supply chains for e-commerce giants, food distributors, and logistics operators throughout the region. MLT's portfolio strength speaks for itself. Its assets under management now stand at roughly 13 billion Singapore dollars, supported by a high occupancy rate of 96.1%, a steady improvement from the previous quarter's 95.7%. The weighted average lease expiry, or WALE, sits at 2.7 years, giving the REIT decent income visibility. On the rental front, MLT achieved a positive rental reversion of 0.6% overall, with a healthier plus 2.5% if you exclude China. Even within China, where the logistics sector has been challenging, MLT managed to reduce its negative rental reversions from negative 7.5% to negative 3%, showing early signs of stabilization. Across its 970 tenants, the REIT enjoys strong sectoral diversification, spanning logistics, consumer goods, retail, and e-commerce. This mix cushions MLT from shocks in any single industry or country. In short, MLT's regional reach and tenant diversity give it remarkable resilience. It's backed by long-term leases, steady rent escalations, and an experienced sponsor, providing a strong, dependable backbone for income-focused investors who want stability in their portfolios. Chapter 3. Financial results announced on 28th of October 2025. Alright, now let's talk about the numbers. The part income investors like us care most about. For the second quarter of financial year 2025-26, which covers the period from 1st July to 30th September 2025, Mapletree Logistics Trust reported gross revenue of about 177.5 million Singapore dollars, which is down 3.2% year-on-year. Net property income, or NPI, came in at 153.3 million Singapore dollars, which is a 3.3% decline. Distributable income stood at 92.5 million Singapore dollars, slipping 9.6%. And distribution per unit, or DPU, was 1.815 cents. That's 10.5% lower year-on-year, though it's actually up a tiny bit, 0.2%, compared to the previous quarter. For the first half of the financial year, from 1st April to 30th September 2025, the picture looks pretty similar. Total revenue was 354.9 million Singapore dollars, down 2.8%. NPI was 306.7 million Singapore dollars, down 2.7%. And DPU stood at 3.627 cents, which is an 11.4% year-on-year decline. So, what's driving these weaker numbers? In short, currency headwinds and portfolio reshuffling. The strong Singapore dollar, together with weaker Chinese yuan, Korean won, and Australian dollar, reduced the translated earnings from MLT's overseas assets. Plus, recent divestments, basically the trust sold off some older non-core properties, also trimmed short-term income. But hey, not everything is negative. The trust managed to lower its borrowing costs, which helped cushion the impact, and new income started flowing in from the redeveloped Joo Koon Logistics Hub in Singapore, a modern facility that's now contributing to earnings. Overall, MLT's first-half performance reflects a temporary softness due to foreign exchange movements, rather than any structural weakness. The trust remains operationally sound, maintaining high occupancy and stable rent growth, which is definitely a reassuring sign for long-term dividend investors. Chapter 4. Is MLT fairly priced or flying under the radar? So, let's get into the valuation breakdown of Mapletree Logistics Trust, based on its official disclosures released on 28th of October 2025 and the unit price of $1.35 as at 3rd November 2025. This analysis gives a fair and balanced picture of where the REIT stands: steady, fairly valued, and financially disciplined. At that price, MLT's market capitalization comes in at roughly 6.9 billion Singapore dollars, calculated from around 5.09 billion units in circulation. This lines up closely with SGX data, which puts the trust's valuation between 6.7 and 6.8 billion, depending on market fluctuations. The price-to-earnings, or PE ratio, sits around 31 to 33 times, reflecting MLT's premium pricing compared to peers, a sign that investors are willing to pay up for its scale, stability, and track record. Meanwhile, MLT's net asset value, or NAV, per unit stood at $1.26 as of 30th September 2025. Based on its $1.35 unit price, that gives a price-to-book, or PB ratio, of about 1.07 times. While that's slightly above its book value, this premium is pretty reasonable for a blue-chip REIT with high-quality assets and a reliable sponsor. On the balance sheet side, gearing remains at 41.1%, well within the MAS regulatory limit of 50%, so there's still headroom for future acquisitions or redevelopment projects. The average cost of debt improved a little to 2.6% per annum, down from 2.7%, thanks to proactive refinancing and a healthy proportion of fixed-rate loans. Its credit rating of BBB+ from Fitch further confirms its strong financial footing, while its return on equity, or ROE, of around 3.3% is consistent with other income-oriented REITs that prioritize stability over aggressive growth. So, my take? All in, MLT appears fairly valued, trading near its intrinsic worth, neither a bargain nor overextended. With moderate gearing, efficient capital management, and disciplined refinancing, MLT stands on solid financial ground. For long-term income investors, it continues to represent a well-managed, resilient REIT that can deliver steady returns through changing rate cycles. Chapter 5. Dividend Yield and Sustainability. Now let's talk about dividends. At the current unit price of $1.35, Mapletree Logistics Trust offers investors a trailing yield of about 6% and a forward yield projected between 6.5 and 6.8% based on management's latest performance outlook. That's why MLT is often called a 6% dividend yield REIT, offering a realistic, stable, and attractive return for Singapore income investors who value consistency over speculation. But the key question is, how sustainable are these payouts? If we look a bit deeper into the financials, we'll see that MLT's payout ratio has edged above 100%, which means it's distributing slightly more than what it earns from recurring rental operations. This is mainly because the REIT included about $6 million in one-off divestment gains during the second quarter of financial year 2025-26 to support its distribution per unit, or DPU. Without these divestment contributions, operational DPU would have fallen by roughly 4.8% year-on-year, a modest dip, but one that highlights the pressure from currency headwinds and reduced income from recent asset sales. In other words, while your dividend from MLT still looks stable, part of it is currently being topped up through asset recycling rather than pure rental income. This isn't necessarily a bad thing. It's a short-term strategic move that helps maintain investor confidence and smooths out earnings while the REIT reinvests in higher-quality modern assets. Think of it like tending to a durian orchard. Sometimes you prune a few older trees so the newer ones can thrive and bear sweeter fruit later. Likewise, MLT is pruning and replanting, selling older assets to strengthen its long-term dividend sustainability. For income-focused investors, this means the cash flow remains steady for now, but the real test of strength will come from how well MLT can grow rental income from its refreshed portfolio in the quarters ahead. Chapter 6. Future Prospects and the Fed Rate Cut Story. Looking ahead, the next chapter of MLT's story will be shaped not just by warehouse leases and occupancy numbers, but by the global interest rate cycle. In October 2025, the U.S. Federal Reserve cut rates by 0.25%, marking the first step in a long-awaited easing cycle. For REITs, that's generally good news. Lower interest rates mean cheaper borrowing costs and, in time, higher asset valuations. However, according to a Channel News Asia report on the 3rd of November 2025, the outlook for further rate cuts in 2026 remains clouded. The Fed has signaled caution, keeping the door open for additional moves, but warning that inflationary pressures and a resilient U.S. economy could slow the pace of easing. For MLT, the implications are mixed. In the short term, things are stable. About 48% of its total debt is fixed rate, which means financing costs are largely shielded from volatility. That provides predictability in interest expenses and helps preserve distributable income. In the medium term, if the Fed continues to cut rates gradually through 2026, MLT stands to benefit from lower refinancing costs and potentially higher valuations, as investors rotate back into yield assets like REITs. But there's also a currency drag to contend with. A strong US dollar and Singapore dollar reduce the translated income from MLT's overseas assets in markets like China, South Korea, and Australia, a challenge that management continues to mitigate through proactive hedging. Operationally, there are green shoots on the horizon. MLT's China portfolio is stabilizing, with negative rental reversions narrowing from earlier quarters. Occupancy has improved to around 94%, and overall tenant retention remains healthy, reflecting the resilience of demand for logistics space across Asia. Putting it all together, MLT's outlook for 2026 looks steady rather than spectacular, built on strong fundamentals, disciplined management, and stable occupancy. While macro headwinds like currency strength and slower Fed easing may cap short-term growth, MLT's defensive structure and diversified base give it the staying power to ride through uncertainty and keep delivering income quarter after quarter. Chapter 7. Key Risks to Watch. Even with its steady performance, investors should remember that Mapletree Logistics Trust, or MLT, is not without risks. Like all REITs with regional exposure, its stability depends on how well it can manage both macroeconomic headwinds and operational challenges across multiple markets. The first and most immediate risk is foreign exchange translation. MLT earns a significant portion of its income in currencies like the Chinese yuan, Korean won, Japanese yen, and Australian dollar. When these weaken against the Singapore dollar, the converted income drops, even if the underlying assets remain fully leased. While MLT actively hedges a large part of its foreign income, a persistently strong SGD can still erode distributable income in the short term. Next is the high payout ratio. Since MLT distributes more than 100% of its operational income, partly by including divestment gains, there's less buffer to absorb unexpected dips in revenue or higher financing costs. This doesn't make the dividend unsafe, but it does mean that management will need to maintain careful capital discipline if rental growth remains slow. A third risk lies in China's recovery. Although conditions have improved, with negative rental reversions narrowing, the market is not fully out of the woods. Rent growth remains slightly negative, and tenant sentiment in some Chinese logistics hubs is still soft. A slower rebound or renewed weakness could weigh on overall portfolio performance. The fourth concern is MLT's dependence on divestments. Selling older non-core properties helps recycle capital and maintain DPU, but it's not a sustainable source of recurring income. If asset sales slow in a tougher market, future distributions could come under pressure unless offset by organic rental growth or acquisitions. Finally, global trade risks remain a wild card. Escalating U.S.-China tensions, regional supply chain disruptions, or weaker global manufacturing demand could all dampen tenant activity and warehouse utilization rates. In short, while MLT is backed by a strong sponsor and robust balance sheet, investors should watch these 5 pressure points closely. They're not red flags, but they're the winds that could sway the REIT's otherwise sturdy sails. Chapter 8. What Singapore income investors should consider. For Singapore income investors, Mapletree Logistics Trust, or MLT, remains a key name to keep on the radar, especially for those building a long-term, dividend-focused portfolio. First, MLT's strength begins with its sponsor, Mapletree Investments, which is part of Temasek Holdings. This strong institutional backing gives MLT access to capital, expertise, and a robust corporate governance framework, 3 crucial factors that underpin its resilience and credibility in the REIT market. Second, MLT's regional diversification is a major advantage. With 175 properties spread across 9 Asian markets and a tenant base of around 970 companies, it benefits from resilient demand for logistics and warehouse space, a sector supported by structural trends like e-commerce growth, supply chain optimization, and the rise of on-demand retail logistics. Third, its 6 to 6.5% yield remains competitive for a large-cap, investment-grade REIT. For investors seeking reliable passive income, that's an attractive middle ground. higher than CPF interest rates or SSB returns, yet backed by tangible, income-generating real estate. However, investors should note that payout quality matters. Not every dollar of dividend is generated from recurring rental income. Part of it has been supplemented by one-off divestment gains. This is not unusual in the REIT world, but it means MLT's management must continue to grow rental cash flows and avoid over-relying on asset sales to sustain distributions. Finally, there are a few key watch points. The pace of U.S. Federal Reserve rate cuts, which will influence borrowing costs and yield spreads. Foreign exchange volatility, particularly between SGD and regional currencies, and China's recovery trajectory, which will affect rental reversion momentum. For steady dividend seekers, MLT continues to serve as a core portfolio anchor, the kind of REIT that doesn't chase hype but consistently delivers income, even when markets get unpredictable. Final thoughts. When you strip away the market noise, Mapletree Logistics Trust stands out for what truly matters: strong assets, disciplined management, and a well-diversified regional footprint. At today's 6% yield, MLT is not a get-rich-fast play. It's a cash flow-rich, not paper-rich investment, built for the investor who values consistency over excitement, the one who wants their copy money to keep flowing quarter after quarter. If global interest rates fall further into 2026, MLT could enjoy a lift in both valuations and distribution growth as financing costs ease. But even if rates stay higher for longer, MLT still offers something rare in today's market: stability and predictability. It's not a flashy REIT, but it's a trustworthy workhorse, quietly compounding income for those patient enough to let time and discipline do their job. If you found this breakdown useful, smash that like button so more Singaporeans can learn how to build passive income the smart, simple way. And don't forget to subscribe to Wealth for You for more insights on CPF, REITs, and dividend investing, delivered every week. As always, may your dividends flow as smoothly as your morning copy.